Doug Lane and Associates and David Malpass, president of Encima Global. Welcome. And David, I just want to start with you because I've been on this for a while, this thought, and that is that it's never a good time to end an accommodative policy. There's always something, it seems like, that says, wow, we can't do it now. But when you look at what's happening with oil prices, there are some that connect the dots between QE2 and what's happened with oil and commodities. So it's almost like self-fulfilling. Here we are. It looks like the training wheels are ready to come off after a better jobs report. But all of this easy money is giving us the next reason to not end the easy money, and that is that oil prices could end up sort of shutting down the recovery. So, I mean, is QE2 finished in June, and is the damage already done?
Hi, Joe. Yes, I think QE2 will be finished in June, and the damage is already done. We've seen it in the weak dollar. We also see it in the Fed's legacy. So for the next 20 years, 30 years, people will expect the Fed to buy assets when we slow down. And I think that's a very bad precedent. But for markets, what they look at is all the money coming at them. So it becomes a trend-following market. You just do whatever you did last week until it doesn't work. And so that means buying oil and buying equities and moving as much money out of the United States as you can.
Did you see Greenspan? Were you able to watch that on Friday, David?
I didn't see him on your show. That must have been great. I saw some of the headlines.
You were...
Thanks, David. Thanks for being with us.
Yes. Sarat, let me turn to you. I'm sure you saw the entire interview. And
Malpass was writing a speech or a paper or testifying in front of Congress.
No, but David, seriously, one of the things that the chairman did talk about was that how dangerous it is to subsidize risk, to subsidize capital, and he couldn't overtly criticize QE2. The one thing he did say was they can pull back these reserves very quickly, and they're not past the point of no return yet.
That's right. I'm not so worried about the exit strategy. I think the Fed can exit. The problem is they keep pushing more in. They're in the markets buying the national debt every day. That's a really bad monetary policy to be running. And on top of that, they have a 0% Fed funds rate when not only is the U.S. doing well, but we have, it's a giant Asia stimulus program. The money is just flowing around the world, and so it's going to hurt us in the long run. The pushback I get from clients is they say, well, markets are forward-looking, so why don't they see this? And the problem with that is it's a 3-year, we're kicking the can down the road, and 3 years from now, we won't like the results. But right now, there's just so much money, people keep going on with the trends.
Mm-hmm. So as far as how all this affects the equity markets, you still feel pretty good about things.
Yeah, we're still pretty bullish. I think short term, you've got some of these hiccups in terms of oil prices that are really offsetting the QE2, but if you look at corporate balance sheets and you look at how much money that they have, and you look at the margins where we are and the potential to grow as opposed to 2 years ago when things were just the opposite. And what really gets me excited is when you look overseas and why are emerging markets raising interest rates? Because things are doing very well. They're growing. So we do have that. And I think over time, what you want to be is invested in these markets in areas that are going to benefit, especially some of the industrials, even in the autos, where things are just, you're below replacement rate. So you are going to grow. And if you look at kind of the opportunity, this is the time to be invested.
Well, are you assuming oil goes back down? Or?
I am. I think oil over time comes below 100. Short term, 6 months, 3 to 6 months, don't know. But that's a tax on the economy, and I think that's offsetting the QE2 as well.
And QE2, I guess an equity strategist isn't going to worry about moral hazard and too big to fail is still around.
No, I think you have to be careful that they don't go to QE3 and then we've really put ourselves into an area where there's so much liquidity and the monetary policy just doesn't work anymore. I think what you have to focus on then is to say, how do they get out of this? And I think people are expecting them to do that.
Does the spike in oil, even though it may be temporary, does that kill any likelihood of QE3? Or make it less likely?
I think it makes it less likely because people, you're just going to flood the economy with so much liquidity, and that's just you're just asking for inflation at that point, which we're already getting now. So I think if you kind of back off that, but the oil is a very important question, and to see kind of what happens in the Middle East.
I wonder too, Senator, we haven't touched on this yet, the reserves and whether or not we tap those. Is that you come down on either side of that debate?
My concern is that especially given the unrest, a disruption of supply looks like it's certainly not that remote a possibility, and I would think in this environment it'd be a good idea to just be pretty cautious about that. But I just wanted to touch on the QE2s. I'm very, very concerned. The combination of record deficits and a Fed that's monetizing 40% of it just strikes me as very dangerous. And if you look at so many of the other typical indicators of monetary policy, whether it's a Taylor rule, commodity prices generally, money supply, the fact that we've got negative real interest rates, all of these things suggest that we're overdoing it now. And I'm not as optimistic that the exit strategy is going to go really well. I think that could be tough.
Well, I think it was interesting is before the oil spike, interest rates were backing up, and the market was already discounting that QE2 was going to be taken off. So now you've got a couple of things moving against each other, and people are rushing to treasuries, and because they're uncertain, and then the dollar's going the other way as well. But I do agree. I think we have to be very careful. We've put ourselves in a position where we need to back out of this, and nobody knows how well it's going to do. Nobody knew when we went into QE2 what was going to happen as well.
David, does Trichet's increased hawkishness give Bernanke some cover to kill it if he wants, or to hike rates if he wants?
I think in a way people will, a lot in the market like the current situation. This is a giant profitable environment for the markets and for well-to-do people. We're paying 0% on savings. So people look at Trichet and criticize him. And so I don't think that works in favor of Bernanke, relenting on this. It makes it look like, hey, more is better. Don't be like Trichet. That's not my view. I think Trichet is looking forward and saying, look, there's too much money in the world. We as central bankers ought to be raising rates. But that logic is just not in the U.S. Pedal to the metal is our name of the game here.
David, could I just ask you a quick question? I'm just wondering, to what extent do you think that the divergence in policy between the ECB and the Fed is related to the fact that the Fed has the dual mandate and the ECB has a single mandate? In other words, the ECB's only obligation is price stability, but the Fed is required by Congress to also attempt to maximize employment. Do you think that drives this?
Senator, I think that's right. That's some of it. And the other thing I'll add in is the difference on the inflation measures that they're looking at. The ECB looks at headline inflation. The Fed stubbornly looks at core inflation, even though we all know that inflation is your overall prices paid. And so the Fed has it set up to constantly be behind the curve. That's what happened to Greenspan in 2005 and 2006. In 2004, he had the rates set way too low. And yet the Fed never figured that out because the core measures didn't pick it up.
Yep.
They're a deep lag.
If you think the economy is your responsibility, that's a lot of responsibility. It's a tough job to start with Bernanke, but we've had the illusion. Some people think the Fed should jumpstart the economy. That's fine. You take the jumper cables off, right? But what if the Fed thinks it's supplying the gasoline to the economy? Then you've got, that's the two different types of Feds that we have. And I think we got a Fed, at least a Fed chairman, that thinks I'm supplying the gasoline.
That's right. Bernanke in recent speeches has talked about the need for the Fed to support growth, which is a whole new mandate. They've basically made a triple mandate for the U.S. growth, unemployment, and price stability, which is too much for anyone.
Yeah, all right. Thank you. And thanks, David. See you later.
Thanks.
Okay.
When we come back this morning, a closer look at some of those rising commodity prices. At the top of the hour, Douglas Holtz-Eakin, the former CBO director, will join us, talk about the budget face-off with Senator Toomey, our guest host, when Squawk continues.
Time now for today.